Imagine this for a moment. You finally have some extra cash sitting quietly in your bank account. It feels safe, responsible, even comforting. You worked hard for this money, so naturally, you want to protect it. But here's the uncomfortable truth most people never talk about. That money is silently losing value every single day. Not because you're wasting it, not because you're careless, but because inflation is constantly eroding its buying power. Prices rise year after year, while your money just sits there doing nothing. What feels like safety is actually slow financial decay. And that's why today's video exists, to explain, in simple terms, how complete beginners can invest smartly in this year, without hype, without gambling, and without complicated jargon, so your money starts working for you instead of against you. Let's start with the most basic question: why invest at all? Why not just save? Saving feels logical. Saving feels disciplined, but saving alone is no longer enough. Imagine you have $1,000 today. You put it in a savings account earning maybe 3 or 4% interest. At the same time, inflation is running at 5, 6, or even higher. That means, in real terms, you're losing money every year. Your purchasing power keeps shrinking. This is why things that used to cost $5 now cost $9. Why groceries feel more expensive even though your salary hasn't doubled. Investing is not about getting rich overnight. Investing is about protecting your future self from this silent erosion. It's about ensuring that your money grows faster than inflation so that 5, 10, or 20 years from now, your lifestyle doesn't shrink even though you saved diligently. So, how does investing actually grow money? It's not magic, it's math and ownership. The first way is ownership in real businesses. When you buy a stock, you are not buying a lottery ticket. You are buying a small piece of a real company that sells real products and earns real profits. Take a company like NVIDIA. When NVIDIA designs better chips, sells more products, and increases profits, the company becomes more valuable. And because you own a piece of that company, your investment grows along with it. The second and more powerful force is compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world because once compounding kicks in, growth accelerates on its own. Money earns returns, those returns earn more returns, and over time, growth becomes exponential. Someone investing consistently over decades often ends up with far more wealth than someone who invests larger amounts but starts late. To understand how powerful compounding really is, consider this simple example. If you invest $1,000 every month and earn an average annual return of around 10%, which is roughly what broad stock markets have delivered historically over long periods, you could reach around $100,000 in about 6 years. That sounds impressive, but here's the part most people don't expect. The next $100,000 takes significantly less time. As the base grows, compounding accelerates. Eventually, your portfolio can grow by tens of thousands of dollars per year without you adding anything extra. This is why time in the market matters more than timing the market. Starting early, even with small amounts, often beats starting late with large sums. Now, let's talk about what beginners should actually invest in, because this is where most people go wrong. Beginners often chase hot stocks, trending companies, or viral investment tips. They see a stock that doubled last year and assume it will double again. History shows this thinking is dangerous. Companies like BlackBerry and Kodak were once market leaders. At their peak, investors believed they were unstoppable. Then technology changed, competition increased, and those stocks collapsed. Past success does not guarantee future returns. Betting everything on one or two companies is not investing, it's speculation. Real investing is about managing risk while aiming for long-term growth. This is where index funds and ETFs come in. An index fund allows you to invest in hundreds of companies at once instead of trying to guess which single stock will win. Even Warren Buffett, one of the most successful investors in history, has said that most people are better off investing in low-cost index funds. Jack Bogle, the founder of Vanguard, famously said, "Don't look for the needle in the haystack, just buy the entire haystack." An index is simply a list of companies, like the S&P 500, which includes the largest companies in the United States. A fund pools money from many investors and buys those companies on their behalf. When you invest in an S&P 500 index fund, you automatically own small pieces of Apple, Microsoft, Nvidia, Amazon, and hundreds of others. This diversification reduces risk because even if some companies fail, others continue to grow. Another key advantage of index funds is cost. Most index ETFs have very low expense ratios, often below 0.1 or 0.2%. This means more of your returns stay with you instead of going to fund managers. Over decades, lower fees can make a massive difference in final wealth. ETFs like SPY, VOO, IVV, or SPLG all track the S&P 500 and are widely used by long-term investors. The goal here is not excitement. The goal is consistency. Boring investments, held for a long time, often outperform exciting ones chased emotionally. Once you know what to invest in, the next question is when and how much to invest. Before investing a single dollar, there are two boxes you should check. First, do you have high-interest debt, such as credit card debt with interest rates above 7 to 12%? If yes, paying that off should come before investing. Paying off a 25% credit card is like earning a guaranteed 25% return with zero risk, something the stock market cannot promise. Second, do you have an emergency fund covering 3 to 6 months of expenses? An emergency fund protects you from being forced to sell investments during bad times, which often locks in losses. Once these two foundations are in place, you're ready to invest. Many people believe they need thousands of dollars to start investing, but that's no longer true. Today, you can start with as little as $1. The more important factor is consistency. Investing small amounts regularly builds discipline and harnesses compounding. A simple rule helps here. Only invest money you need for at least 3 to 5 years. The stock market is volatile in the short term. Prices move up and down, sometimes sharply. Anyone claiming they can predict short-term market movements is lying. Over the long term, however, markets have historically trended upward, rewarding patience. Actually buying your first investment is far simpler than most beginners expect. You start by opening a brokerage account or a retirement account like a Roth IRA through platforms such as Vanguard, Fidelity, Schwab, or Interactive Brokers. The setup usually takes just a few minutes. You link your bank account, transfer funds, search for the ETF or stock you want, choose a market order, and click buy. That's it. No shouting on trading floors, no complicated paperwork. You are now an investor. What matters next is not constant trading, but disciplined behavior over time. Finally, let's talk about strategy because investing is as much psychological as it is financial. The biggest enemy of investors is not lack of information. It's emotion. Fear and greed cause people to buy high and sell low. During market crashes, panic selling feels rational in the moment. History shows it is usually a mistake. During the 2008 financial crisis, markets collapsed and many investors sold at the bottom. Those who held on and continued investing eventually saw their portfolios recover and grow far beyond previous levels. Studies show that missing just the 10 best days in the market can cut long-term returns by more than half. Markets don't rise smoothly, they surge unexpectedly. Being invested matters more than being clever. So here's the real question for you. Are you going to let fear, confusion, and inaction control your financial future, or are you finally going to take the first small step toward letting your money work for you? If this video helped you see investing more clearly, keep learning, stay consistent, and remember, the best time to start was yesterday, but the second best time is today.